It's a great question. So there's actually can be both a state and or a federal death tax when people die. In Louisiana, we no longer have a Louisiana inheritance tax, but certain states still have a taxing system at the state level. At the federal level, the good news is that there's an exemption from the estate tax that is currently $5,450,000 per spouse. So a married couple can pass almost $11 million free of the tax. So for a lot of families, probably 99% of Americans, they don't have a current estate tax liability to worry about. But for those clients that do or may in the future, it can be a pretty egregious tax. It's frankly why I went into this area of law 23 years ago, was because I hated to see, people, most of the people we've worked with are first generation wealth. They didn't have any money growing up. They built their businesses, and for the government to come in and take 40% when they die, to me, is just awful. It's destroyed farms and family businesses, which then results in people being unemployed. And I just, really am passionate about the fact that the tax is awful. And the reality is that if you do the right type of planning, in large part, a lot of times we can eliminate the tax, even for states that are $50, $100 million or more. You just have to do the planning. A lot of people don't realize that there's actually pretty much all of your assets are subject, to the tax when you're calculating it. So people say, well, that it doesn't include my home. Well, actually it does. So all of your real estate, homes, second homes, vacation properties, timeshares, all of your retirement accounts. And people say, well, wait a second, if I'm taking money out of my 401k, a lot of times it's subject to income tax. You're telling me that there's an estate tax as well? Unfortunately, they look at all of your assets. One of the biggest issues is the fact that most people don't realize even the death benefit of your life insurance policies are subject to the estate tax. So if you had a $10 million, single life term policy with no cash value, if that's the only asset you own and you pass away and you're not married, then there would be a tax, because the IRS treats that, if you own that policy, as if you had that $10 million in your pocket. And the tax rate currently is 40% on everything above the exemption amount. So we always, talk with clients, when we start working with somebody, we want to make sure that we have a very, very clear picture of all of their assets. One of the big issues is always on the business. It's always the multi-million dollar question. And the IRS is always going to use what would a willing buyer, willing seller pay for that business. So it's not how much you've invested in the business. It's not what the asset values are. It's how much could you sell this for in the open market. And once you know that number, I usually counsel my clients to always be conservative, which really means using a number that might be on the higher end of a range, because I'd rather plan for a client with a higher number in mind than to underplan and we would go with a lower number, and then if they pass away and the actual appraised value is much higher, we're going to have some problems. The other thing I always caution clients to think about is people don't understand the power of compounding. So if I have a married couple that's worth, let's say, they've got a small business with maybe 10 employees, they've got some retirement accounts, some life insurance, their house, maybe a rental property, and let's say they're worth $8 million, and let's say they're in their 50s or 60s. Well, right now, under current law, they don't have an estate tax, right? Because the exemption's almost $5.5 million per spouse. But what people don't realize is the growth of the assets. So there's a rough rule called the Rule of 72 that says if you take the growth rate of an asset and divide it into the number 72, it tells you how quickly that asset will double in value. So if we have, in the stock market, for example, since the 1920s has grown by approximately 9%. But even let's say, your asset's growing at 7%, 7.2%. An asset growing at 7.2% will double in value every 10 years. So if I have a married couple age 60, their joint life expectancy might be 30 years. So if their assets grow at 7.2%, people can't imagine this, but I can assure you if you run the numbers, they go from 8 million and it's going to, over 30 years at 7.2%, it's going to double in value 3 times. That goes from 8 to 16 million, 16 to 32 million, 32 million to 64 million dollars. Needless to say, they would have an estate tax very likely to happen in the future. So it's oftentimes better to get that under control now before your estate even exceeds the exemptions. And there's a number of different sophisticated estate planning techniques that our firm uses that we'll be happy to share with you. If you just call us up, and we offer complimentary initial consultations, we'd love the opportunity to talk with you and see how we can help you.